Today, we're looking at three most important charts for Thursday, June 29th, 2023. And if you like this content, give it a like and subscribe, and you'll be notified whenever we put out a new video. So in today's morning's trends piece for clients, we looked at a host of different indicators for the S&P 500 to get a handle on where we are right now after pulling back for the last week and a half after, of course, ripping higher through 4,400. And so one thing we look at here, this is the daily chart of the Bollinger Bands. As you may know, Bollinger Bands really looks at the 20-day moving average, which is here, this dotted line, and the upper band is 2 standard deviations above this average, and the lower line is 2 standard deviations below it. And so on occasion, when you're in a oscillating market like this, if it hits one of the bands, it has a tendency to bounce. But as we can tell, in trending markets, it can tend to be there for quite a while. And so over the last number of weeks since we started rallying from the March lows here and through April and May, it's been hugging really the upper line more often than not. Again, just coming back down to this 20 moving average. And so we saw it again at the beginning of this year too. And so as we can tell, this is a trend starting to develop because going back to 2022, during the thick of the worst price action, it only really tagged the upper line a handful of times, right? Up until, of course, the October low here. And that is pretty rare because in uptrending markets, you have a tendency to hit this a good amount of times and really not get too much in contact with the lower line. And again, that has really changed since the low here in March, and specifically over the last 2 months. And this is even more evident if you look at this from a weekly perspective. So the same concept applies. These are just weekly bands as opposed to daily. And so one thing that's really striking is that if you look at 2022, which is the entire period here, on a weekly basis, not one time last year, not once after the initial fall, did the S&P 500 get in contact with the upper band on a weekly basis, not one time. So if we just waited for that to happen, we would have stayed out of this entire market, of course. And now it's been occurring since the beginning of this year. Again, when we first got up there in the end of January, early February, and then again recently. And even more striking is to see what happened over the last number of years, especially during the best uptrending markets. And we see, from the beginning or the middle of 2020 all the way through the end of 2021, what happened here? The S&P stayed in between the 20-week moving average and the upper Bollinger Band the entire time, right? So not once did it hit the lower band until the beginning of 2022. So again, just using this as a guide would have kept us out of trouble on both sides of it. I mean, go back to 2019, you see it happened here in 2018 before the fourth quarter rollover, and again from 16 all the way up to the beginning of 2018. It's a huge run. And so again, from a longer term perspective, this is very important to see continue. And the last chart here is just looking at the S&P 500 here on top and the number of 52-week highs that its components have been hitting over the last number of years here. And so recently it got to a high of 59. And so people that are bearish on the market will say that's not a lot. And of course, the biggest gripe on the market's comeback, especially since March lows, was that it was thin, and really was to an extent with technology leading so much. But over the last few weeks, it's really broadened out a bit. But still, this number is still low. Now, two things about this. Number one, this is a lagging indicator because as the market comes back, there's going to be different areas moving higher and coming from different spots because some of them start from a much lower area. And in fact, the S&P itself is still 10% away from its last all-time high at the beginning of last year. So we still have a while to go. So as the market continues to move higher, other stocks will come along with the ride too. And if you look back again toward over the last number of years, as these different uptrends developed, what we can see here is that the number of new highs just continued to expand as the uptrend continued. Now, it happened in different variations over different time frames, but the same type of behavior occurred every time here. So what does that mean? That means if we expect this uptrend to continue, and so far it's still displaying the characteristics of an uptrend, that means we'll expect this number to get bigger as well. And so you can even see it double. Wouldn't be surprised at all to see it get to above 100, 150, so forth and so on, until it's time for a more immediate pullback. And I would say it doesn't have to happen right away, but it does have to happen over the course of, say, the next 6 months to see it expand, especially if the S&P continues to move higher. And so to read this full report and many others like it, please visit CappThesis.com and you can sign up for a 30-day risk-free trial. That's it for today. Talk to you next time.